Okay, let's get into it. Welcome back to the deep dive. Today we're unpacking Uber Technologies' Q3 2025 earnings call. We've got the transcript, the financials, all of it.
And our mission today is really to get past the headlines. Uber's in the middle of this huge strategic shift, and these Q3 results are basically the proof point for how they're funding it.
They're moving beyond just rideshare, right?
Way beyond. They're explicitly building a global hybrid platform. It's all about cross-platform use and, these big long-term bets on things like autonomous vehicles. We really need to understand the nuts and bolts.
And Q3 definitely gave them a reason to be confident. Management kept calling it an outstanding quarter. They're pointing to execution and innovation across the board.
The acceleration is the real story here. I mean, look at the numbers. Total trips grew 22% year over year. That's 3.5 billion trips in just 3 months.
Wow.
Yeah. And that growth rate, it's the fastest they've seen since 2023, which is just incredible when you think about the scale they're already operating at.
And that momentum directly feeds the top line. Gross bookings shot up 21%. Hitting nearly $50 billion for the quarter.
Exactly. And that massive demand is what they're calling their profitability flywheel. It's finally spinning on its own.
What about the user base itself?
The scale is, it's hard to ignore. They hit an all-time high of almost 150 million monthly active users. And it's not just more people, they're using it more often. Audience was up 17%, and frequency was up 4%. That's the combo you want to see.
Okay, so let's get into the scorecard, the financials, because the story isn't just volume, it's cash. Revenue came in at $13.5 billion, which easily beat the street's estimates.
And mobility trips grew 21%, which was even better than their own internal forecasts.
So that brings us to profitability, and this is where we have to be a little careful, right? They reported this massive GAAP net income of $6.6 billion.
An almost unbelievable number, and you absolutely have to look under the hood on this one.
Oh, yeah. That number isn't all from operations, is it? It's distorted by a one-time thing.
Exactly. There's a huge one-time non-operational benefit of $4.9 billion from a tax valuation release tucked in there. So you have to strip that out.
So nearly $5 billion of that profit was basically, what, accounting cleanup?
Pretty much. It wasn't from selling more rides or delivering more food. The real story is the underlying operational profit, but that headline number is distracting.
That definitely puts it in context. But the cash flow,
yeah,
that's real. And it's staggering for a company that, used to burn cash like crazy.
It really is. We're talking nearly $9 billion in free cash flow over the last 12 months, and they're putting it to work right away, buying back shares. That's a huge signal to the market.
Speaking of signals, management said something really interesting. They're deliberately moderating the pace of margin expansion. Why would you want to slow down profitability?
Because they see a bigger prize. They're choosing to reinvest in things they think have a higher long-term return. Things like building out their grocery business, launching low-cost options in new areas, and of course, AV tech.
So it's growth over immediate max profit.
It's strategic growth. And that ties right into this big metric shift they announced. They're moving away from adjusted EBITDA and want everyone to focus on adjusted operating income, or AOI.
Okay, so break that down for us. Why does that jargon matter so much?
It matters because it's Uber basically saying we're a grown-up company now. Adjusted EBITDA is, let's say, a generous metric. It ignores real costs like depreciation and stock-based compensation.
Which are huge costs for a company like Uber.
Huge. AOI, on the other hand, includes those costs. So they're committing to growing that number every year. It's them saying, okay, you can measure us against a Google or an Amazon now, not just other gig economy startups. It's a major step up in maturity.
That really does feel like a coming-of-age moment.
Okay.
Before we dive into the business segments, we should probably do our usual disclaimer. Just a quick reminder for everyone listening, all the information and analysis we're talking about here is for educational purposes, really just to help you understand the market better. It is definitely not investment advice. Investing always carries risk, so please be sure to do your own thorough research or talk to a professional financial advisor before making any decisions. All right, let's get into the core engine. Mobility and delivery. The delivery side saw this huge kind of unexpected acceleration.
Absolutely. Growth accelerated by 4 percentage points year over year. That's the fastest they've seen in 4 years for that segment. It proves the post-pandemic delivery boom has legs.
And the margins are getting better too.
Dramatically better. They've gone from a low 2% margin in late 2023 to almost 4% now.
And what's driving that isn't just ordering from restaurants anymore. It's this expansion into local commerce, grocery and retail.
This is the huge pivot. That part of the business is now at a $12 billion gross bookings run rate. And here's the key part. It's growing significantly faster than the original restaurant business.
And it's actually profitable on its own now, right? You mentioned its variable contribution positive. What does that mean in simple terms?
It means it's carrying its own weight. After you pay for the groceries and pay the courier, there's money left over. It's not a loss leader being subsidized by the rides business anymore. It's a sustainable, profitable business in its own right.
Okay, let's switch to mobility. The growth story there is less about the big, dense cities and more about the suburbs.
Correct. They're calling it their sparse geography strategy. Management thinks they're only about 20% of the way into that total opportunity.
So 80% of the runway is still ahead.
That's how they see it. And the growth rates are proving them right so far. Those sparse areas are growing about 1.5 times faster than the dense city centers.
But it's harder to get a car in those areas.
Yeah.
So how are they solving that?
Product innovation. They talked about a feature called Wait and Stave. Basically, if you're not in a huge rush, you can choose to wait a little longer. That gives their algorithm more time to find a car, which helps them manage the lower driver density.
That's smart. It makes the system work even when there aren't drivers on every corner.
Exactly. Meanwhile, in Europe, they're facing some pretty aggressive competition.
Right. How are they holding up?
They claim they're in a leading position. #1 in the UK and France, and gaining in places like Spain and Germany. They argue their growth is organic, built on reliability and the platform.
As opposed to
Competitors who, in their words, bought their way in with acquisitions. They're hinting that leads to messy integration problems that Uber, by growing organically, avoids.
And that ability to cross-sell between the two platforms is what brings us to their next big strategic bets.
This is where it all comes together. The key stat, the one that drives everything, is this. Cross-platform users, people who use both rides and deliver, spend 3 times more.
3 times. And they stick around longer, too.
They retain 35% better. These are by far their most valuable customers.
But here's the disconnect that I found fascinating. The potential is huge, but the reality is not there yet.
Not even close. In markets where they offer both services, only 20% of their customers use both. So you have this massive 80% of their user base that's only using one side of the app.
And it said something like 75% of riders have never even tried grocery delivery.
Exactly. So the whole game now is converting that 80%. They're using personalized AI prompts like, hey, want to order a Starbucks on your way to work, to get mobility users to try delivery.
And the Uber One membership is the main vehicle for that. It's up to 36 million members now.
It's totally foundational to the strategy. Uber One members make up 2/3 of all delivery gross bookings, but the economics are a little counterintuitive at first.
How so?
They admitted that for the first 6 months, a new Uber One member is actually profit negative.
Wait, what? So they lose money on them at first. The discounts cost more than the extra business they bring in.
In the beginning, yes, but they see it as an investment. After that 6-month mark, as a higher retention and, crucially, the cross-platform habits kick in, those members become super profitable. It's a long-term play on customer value.
Okay, let's talk about the other huge bet, the one that feels like science fiction. Autonomous vehicles.
Right. And their strategy is now very clear. Build a hybrid network. They're not building the tech in-house anymore. They're leaning on partners.
Like NVIDIA.
NVIDIA is the big one for their level 4 autonomous systems. And they have a deal with Stellantis for an initial 5,000 vehicles to get started.
But they tried this before and sold off their division. Isn't this just giving up control of their own future?
Well, they would argue they're focusing on what they do best, managing the network. Let the partners handle the incredibly expensive and difficult R&D of actually building the self-driving car. Uber provides the platform, the demand, and the routing.
The early results from the pilot cities are kind of mind-bending.
They really are. In places like Phoenix and Austin where AVs are operating, the overall market is growing more than twice as fast as the rest of the U.S.
But here's the part I can't get over. They said driver earnings in Austin, the city with the most AVs, are actually growing faster than the rest of the country.
I know, it's completely counterintuitive. The assumption is AVs take money out of drivers' pockets.
But this suggests they might actually grow the whole pie. More reliability brings more riders for everyone.
The company was careful to say it's just correlation for now, not causation. But it suggests that AVs and human drivers can coexist, maybe even help each other, by increasing overall use of the platform.
Still, these things aren't profitable yet. How does that fit with their new focus on AOI and real costs?
They were very direct about it. AVs are unprofitable now and will be for a few years. They see it just like any other new market they've entered. invest heavily to build supply and liquidity first, then focus on profit later.
And who's going to own all these expensive cars long term?
Uber might use its own balance sheet at first, but the long-term goal is to have these fleets be financialized, owned by third-party investment firms like REITs or private equity who are looking for yield. Uber just manages them.
Before we wrap up the future bets, there was this multiple gigs thing, expanding the platform beyond moving people and things.
Yeah, this is Uber AI Solutions. It's basically using their massive global network of earners for digital tasks. Things like training AI models, annotating video. Some of it is even highly specialized work that requires, say, a PhD in physics. It's another potential profit stream.
Let's quickly touch on some operational levers. Insurance is a huge cost. They see savings coming.
Hundreds of millions of dollars, they hope. It's coming from two places. Legislative changes like in California and tech. They have this driving insights dashboard now that gives drivers feedback on their safety to help lower accidents.
And they plan to pass those savings on as lower fares, right? To feed that flywheel.
That's the plan. On the partnership side, the integration with Toast, the restaurant software, seems like a smart move to make life easier for merchants.
Right. If a restaurant uses Toast, getting on Uber Eats is almost automatic.
It's seamless, and it's a two-way street. Uber is helping Toast expand internationally. It makes the relationship really sticky.
And finally, the big one, AI. Is it a threat that could replace their app, or is it an opportunity?
They see it as both, so they're embracing it. They're building their own chat agents using their own data to give you personalized suggestions that an outside AI couldn't. But they're also partnering with companies like OpenAI to make sure that if you ask ChatGPT for a ride, Uber is the one that shows up. They want to be the fulfillment layer for AI.
And all the data they're collecting from their cars, especially for the AVs, gives them a huge advantage there.
A massive advantage. They have real-world data on the messiest parts of driving airport pickups, stadium drop-offs. They're feeding that directly to partners like NVIDIA to train the AV models on the things that actually matter for ride-sharing.
Okay, so to wrap this all up, it feels like Q3 confirms their profitability flywheel is really working now.
It's working, and it's maturing. That strength is giving them the cash and the confidence to invest in these huge long-term bets. The whole game really is converting their massive user base from single product users into these super valuable cross-platform members, all while laying the groundwork for this hybrid AV network.
That barbell strategy, balancing the profitable core business against these heavy long-term investments, is everything. So here's a final thought for you to chew on. Uber has promised to grow its adjusted operating income every single year. That's a commitment to short-term financial discipline. How will they balance that promise against the AV strategy, which they admit will lose money for years? That tension between today's profit and tomorrow's platform is going to define the next chapter for this company. Thank you for tuning in. We hope you enjoyed today's content, and we will catch you on the next deep dive.